You're welcome to our accounting class at New Idea Consult Academy. This accounting class today is focusing on financial management, and the topic is liquidity, ratio, and financial interpretation. So, the topic we're going to handle again is liquidity ratio and financial interpretation. And at the end of this class, the students should be able to understand what is called liquidity, to define liquidity ratio, and as well uh, calculate the current asset, the value of current asset in the equation, and also calculate the value of what current liabilities, and as well compute the ratio analysis using quick ratio and current ratio in liquidity ratio, and also interpret the financial implication of a company. That's what the student stands to gain at the end of lecture today. So let us look at the topic again. We say that the topic is liquidity ratio and financial interpretation. What is liquidity? Liquidity is the ability of a company to meet its financial obligations and promises at when fall due. That is what is referred to liquidity. If a company is able to meet the obligations, the financial obligations and promises as when promised, as when fall due, that is what the liquidity. If the company will be able to meet all these obligations and have something to continue the business, that shows the company is liquid. And that's a terms described as liquidity of a company. Now let us look at also the other terms associated with liquidity ratio analysis. Under this term, we have current assets, we have current liability, we have stock. Now we have current assets and current liability. What is current asset? Current assets are those items the company held that is convertible to cash within one accounting cycle. That is current assets. Current assets are those items or stocks that the company is convertible to cash within one accounting period. Current liability is simply means those obligations that the company is owing to the to other third party within one accounting year that they are expected to pay. That is current liability. Those under current liability is simply describing the items that the company or the organization is liable to meet its promises at when fall due within one accounting cycle. Now we have stock. What is stock? Stock remaining simply means the remaining unsold value of stock in trade. That is the item of resale in a business that the company going to that have not sold at the end of the period. That's what is referred as a stock, and is convertible to cash. Now, also having described that, let us look at the types of ratio, the types of liquidity ratio. Under liquidity ratio, we have types. Then in this class, we're going to focus on only two and calculate it. One is the what? The current ratio. Current ratio simply means the ability of a company to meet its obligations in to meet its obligations such as the current liabilities and pay them through their current asset without going to sell their fixed asset. The ability of a company to meet its obligation within the current cycle using their current assets to settle their current liabilities without resorting to selling of the investments or looking for public funding or looking for how to sell the company properties. That is what is called current ratio. That ratio tests the ability of the company to measure up and meet its obligations as well for due under there's to pay the current liabilities from the current asset without going to sell the permanent asset or fixed assets or non-current assets of the business. Now let us look at another one known as current liabilities. Current liabilities is there's a current or quick ratio. Sorry, quick ratio. This is referring to the ability of the company to meet its obligation after removing stock from current assets. Then the ability to pay their obligations under current liabilities without resorting to borrowing or selling of the property when the stock is removed. Another name for quick ratio is the acid test ratio. When the acid tests are placed on the company liquidity, can they be able to pay their debt when the stock is removed? Can they be able to pay their debt and still have something to continue the business without selling their stock or resorting to sale of the property to meet up the obligation? That is acid test ratio. Having defined that, now let us look at the question. In this question, you are required to do what? Calculate the current ratio and the quick ratio of the company. We're using ABC Limited as a company in this question. So the students should pay attention, use the calculator and your pen to take up your record. The record you're going to take will help you to do your computation and assess and as well make your notes in this lecture. And if you have any question, please you direct it to us. Now, ABC Limited had the following financial record for a particular period. Let's say 31st December 2023. And the position is the loan of the company is 20,000. The creditors is 70,000. The payables is 10,000. The accruals is 88,000. The unpaid interest is 12,000. Making a total of what? 200,000. And that 200,000 represents the current liabilities for the period. In the same period, the current asset as follows: bank balance 60,000, cash balance 40,000, stock 50,000, debtors 300,000, prepaid bill 100,000, receivable bills 200,000. Then we have current assets. In this question is 750,000. Now you are required to calculate what? The current ratio and the current what? The quick ratio using the above question. And as well interpret and advise the management. Now, to solve this question now, you first of all now say, what are you required to do? You are required to do what? Calculate the current ratio. What is the formula for current ratio? Current ratio formula is simply current asset over current liability. Current asset over current what? Liability. Then whatever you have, now in that question we have the current asset in the question there is what? 750,000 naira. That's the current what? As the current asset in that question. Why the current liability is what? Is a 200,000. 200,000. Therefore, the current ratio is 750,000 over 200,000 will give you 3.75, which means the current ratio is 3 naira 75 kobo is to 1 naira. What does it mean on interpretation, financial interpretation? It means that the company ABC Limited for the period had 375 naira for every 1 naira they are owing under current liabilities. For every 1 naira they are owing outsiders under current liabilities, they have 3 naira 75 kobo, which means the company is liquid. If that 1 naira is being paid, the company have something to continue the business, which means the company is liquid. That is how to attest the liquidity of your organization using current ratio. Now, the second question there is what? Calculate the what? The quick ratio. Quick ratio or acid test ratio simply means when the stock is removed from the current assets divided by the current liability. That's the formula. We state it again. We say that the formula is for the quick ratio. Or another word for the quick ratio is what? Acid test ratio. The formula is what? Current asset less stock divided by current liabilities. Now, in the question there you have the current asset is 750,000 naira. While the current liabilities is 200,000. Now, from the question, then we have stock. The value of the stock in the question there is what? 50,000 naira. That 50,000 naira, when you less 50,000 from 750,000, you have what? 700. 700 divided by what? 200. 700 divided by 200 will give you 3.5. When it gives you 3.5, that 3.5 simply means that in every 1 naira the company is owing under current liabilities, that they have 3 naira 50 kobo. That is, in every 1 naira the company is owing under current liabilities, they have 3 naira 50 kobo. Which means if that test is placed on the company can pay their debt and still have something to move on under asset test ratio. Under asset test ratio. So we have this outcome, which means that the company's financial position is favorable. That is, liquidity ratio is the method of assessing the viability of the financial position of the company to meet its financial obligation and promises as well for due. So we have used these two questions: computation of current ratio and computation of asset test ratio. We described it again that the formula for current ratio is current assets over current liabilities. You can convert it to percentage if you want, but I use ratio in this class. For the benefit of the student, we use ratio. If you want to convert it to ratio, you can convert it to times 100 over 1. Then whatever I have is going to be in percentage. But now we use ratio. We now say current ratio equals to current asset over current liabilities. Then whatever you have, that's what it gives you. You now interpret it based on 1 naira. Based on 1 naira, you match it with 1 naira. That's what it means. Then under quick ratio or asset test ratio, the formula is current asset less stock over current liabilities. Then you go to the question, calculate the value of the current assets. You can pick that through the statement of financial position. Go to your financial position and look at the current asset value and get it. Then move again and go to the side of the stock. Calculate the value of the closing stock for the period reported in the current asset and remove it. Then you now go to the under current liabilities. Calculate what the company is going to pay within a short-term period of running the business within one accounting cycle. Then calculate it and extract the figure. That is current liabilities. Then when these things are done, you match it and do the computation. So you're welcome to this class. If you have any question, please direct it to us at christophergen1@gmail.com or send us your email at newideaconsultnigeria@gmail.com or send us a text message at 08035869524. 08035869524. Send us a message there. And if you have any question, please direct the question to us. Please, I would like you to like this message and share it. This class is very important for those students who are studying accountancy and those in the Faculty of Management and Social Science. It is very important for them. It's equally good for the business managers because ratio analysis helps the managers to make financial planning, financial control, and financial estimation to enable the business achieve its corporate objectives. You're welcome and God bless you.